Thank you for all of you who are coming back. Please sit now. Before I really start, I think there's something missing. There's a big question mark all of us have. And without answering this question, we are all going to go back tonight and just now what did I say? Very cake. Do you know why? Because what was the winning question? Does anyone know that? Don't know. So let me invite the guy who won the winning question again to come here. His name is Wilson. I just talked to him. I even took a Wi-Fi with him. And he's going to tell you his winning question, and I will tell you why he won, okay? Right.
Okay, so
Forgot your question?
yeah. So what I emailed in was in a period of higher volatility and lower growth, especially for a small open economy like Singapore, how should the current and future generations save and invest prudently to ensure that their wealth can grow and be protected?
Okay. So he touched on a few things. Thanks very much. Clap, clap, clap. He touched on a few things. Number one, currently it's very volatile. The environment, as we all know, and I'm going to tell you how volatile we will be later. Second thing, he said that, oh dear, if it's very volatile, that means we may lose our money. In that case, how can the current and the future generation save for the future? Now, the reason why he won was because amongst all the, I think, 30 over questions that came in, most of you, sorry to say, I know it's all, I mean, as economists, we all are rational being, right? We want to profit maximize. So most of the question that came in is all about me, myself, and I. It's like, how do I invest? I'm young, you know, things like, okay, not wrong. It's a great question. But for him, the reason why he won, because Wilson's question stood out. He was like, how can my generation and the future generation, quite altruistic lah, right? So congratulations one more time. Clap, clap. Yeah. But I tell you something, I don't have the answer. All of you bring that question back home and think for yourself. And today, we have three speakers. Myself, I'm going to do an overlay of the economic conditions in under 20 minutes. That's really tough. And then we have a second speaker, as you can see, and then the third speaker, they will answer their own portions. And from the three of us, you're going to bring back this question from Wilson, and you're going to think, how are we going to do that? Okay, let me start my seminar proper. Well, you may find weird for economists to be in an investment seminar to talk about financial products and things like that, but it's not weird. Because a lot of things that you invest, even asset classes, you need to look at where the macroeconomic environment is. And in investment philosophy, there are two sorts of approaches that I've always come by. One is called a top-down investment approach, whereby when you want to invest in something, you want to know which country you want to go to. And if you think that the country is not in a good economic shape, you will want to naturally avoid the stocks in that country, avoid the fixed income in that country, unless there is a particular stock that has a strong alpha. Now today, I think that it's not wrong for me to term the title this way, because lots of things have happened since the last time I did the Money Sense seminar, which was early last year. And in early last year, there wasn't this thing at all. I didn't see rising protectionism. I didn't see populism issues. I didn't see negative sentiments from the population. There were a lot of sentiments against freer trade that I've seen in the last 1 year since I last talked in the previous Money Sense seminar. And I want to bring forth one key question that everyone has in their mind. How will this, including Brexit and more exits from the EU, and how will the Donald Trump administration affect rest of us, particularly all of us here in Asia, in ASEAN, and in Singapore? So let's go into the thing proper. Murphy's Law. Hey. Where should I put? Oh, never on. Okay. Well, last year we saw the UK exiting. That was one particular episode, and the market wasn't ready for the exit. Basically, if you were to ask analysts last year, wow, what is the probability of the UK exiting? People will give you a nice number. What number is that? 50%. 50% means you're not saying anything, right? Because no one really knows whether UK will exit or not. In fact, a lot of people, when you talk to them, they say that, no lah, UK won't exit lah, it's impossible. But what happened? It exited. So a lot of people think that it was a black swan event. And thereafter, when they exited, for around 2 days, equity prices dropped big time. And for that long time, we saw the sterling went down by almost 10 big figure. Now the problem is that after the UK exit, will there be more exits? And going ahead this year, indeed, Wilson question, you hit the point. Because this year, there will be a couple of elections coming up. Coming up in March, there will be one Dutch election, and then we're going to have the French election. And then we're going to have a German elections, and then also a Czech Republic elections. So all these are potential points. I will leave you to do the exercise of which month are the elections. But all these are potential points for increased volatility that we will be seeing in the financial markets for this year alone. A key question that my clients usually ask me is that, hey, but that's so far away, Eurozone, Europe, Americas, well, how does it really affect us in Asia? So as an economist, I went to pull out the data, and from here you can see that for us together in ASEAN, all the 10 ASEAN countries today, our exposure to Brexit, which is UK exiting, wasn't that high, because that was only 1.6% of our total exports to the world. To the EU, it was only 1.6%. But for the other countries on the left-hand side, you can see there, US, Hong Kong, they are a lot more exposed to the UK. And if you look at the entire Eurozone together, our exposure is pretty large, 10.3%. But as you know, as I mentioned just now, ASEAN has 10 countries. Not all countries are in an equal financial or economic situation. So if you look at this little scatter plot, for all of you who know scatter plots, well, the y-axis here is exports to UK, and the x-axis is exports to the EU. So naturally, if you think that there's going to be a lot more exits coming up, and it is going to increase anti-trade sentiment, protectionism, wow, you don't want to be a country on the top right-hand side, because that means that a lot of your exports are exposed to these two areas. So you will prefer to be on the lower left-hand side. And Singapore is over here with less than 2%. In fact, our exposure of our exports to the UK is only 0.8% of our total trade. And our exposure to the EU is anything just below 10%. So all the other countries are here, some of the export nations are here, but one big country is the outlier, stood up big time. Their exposure to EU in terms of their export is nearly 35%. Okay, I can hear anyone think, what country is this? Just shout out. Go, 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 come on. Shout. Okay, it's an ASEAN country. Just shout out, I won't be wrong, won't penalize you. Okay, 5, 4, 3, 2, 1, nothing. It's Cambodia. Cambodia. Cambodia's export sector is very much concentrated, not diversified. And today we are talking about financial planning, we're talking about investments. You should diversify, right? And as an economy, Cambodia today, almost 35% of their exports is to the EU. And I'm going to ask you a question again. What industry sector have they been exporting? Oh yeah, I got that close. You're right. So dig into the data further, and you see that other than being so concentrated in their exports to one particular region, and that's the EU, the other concentration that they have is industry. Anything green that you see up there are things that you can put in your wardrobe or things that you can put in your shoe cabinet. Basically, it's apparel, it's clothes. You know, Zara, H&M, Mango, these are the guys who make their things there. So their industry over there, and this is exactly the same kind of industry structure that we saw in Singapore back in the early 50s, 60s, and even 70s. But we came a long way from the early 60s. Today, Singapore is a very different map. If you look at the same thing, this is the structure of Singapore, where we all are today. And first of all, I don't see a lot of green color over there, because our cost is too high as a nation to make textile apparel or even things like that. We are making a lot more machinery, high-value capital goods, semiconductors, and some of the biomedical items. So this is not a single day thing. We took a long time just to come here today. Second problem, not the problem, did I say problem? Second issue, second challenge. If he hears me, what will happen? Second issue, end of last year, well, we all know what happened. I'm sure you all are a very informed lot. Donald Trump wanted to make America great again. Now today I want to tell you some of the things that Donald Trump said to rekindle your memory. Did Donald Trump say that, well, we are going to increase import taxes against China to 45%? I think he did that. He did say that during the campaign. So that is number one. Remember that, 45% tax against China, imports from China. Number two, Donald Trump said that to attract American companies to come back into America, I'm going to make corporate tax, very friendly, very favorable, and that's going to be 15%. Today, Singapore's corporate tax is 17%, so America is going to be 15%, that's what he says. And the next thing is that he says that, I think that American railways and the infrastructure is crap. Did he use the word crap? I'm not sure. But anyway, he says that he's going to increase a lot of infrastructure in America, right? So that's going to be a lot of investment. So there's these three things. Now I'm going to tell you something. These three things are in a very serious contradiction. Very serious contradiction, and we all know why. Now, first of all, in order to increase infrastructure, you need to have money. The US today is one of the largest country in the world with the highest amount of debt. Right? As you can see from this chart, basically, the red color line is GDP, and when GDP is above the blue color line, which is your debt, you're okay. And the different administrations I've plotted over here, but since 2008 onwards, I think 29 or 2010, the total debt outstanding has surpassed the American GDP. And today is nearly 20 trillion US dollars, the largest in the world today. And with Mr. Donald Trump, wow, where do you think American debt will be in the next 4 to 5 years? It's going to be a lot. So what that means is that Donald Trump is going to borrow very heavily if he is going to make his promise of a lot more infrastructure spending in his term. And what that means is that American debt is going to increase sky high. Now that is going to be a problem because the markets price in that with the promise of more infrastructure, you are going to see higher interest rates in the US. And with that, we saw that the 10-year bond yields in American treasuries, it rose from 1.8% just before Donald Trump time, and today it's 2.4%. And I think it's going to go up further if he's continuing to do that. So answer number one, if Donald Trump is going to increase infrastructure spending like what he wants to do, US bond yields is going to rise up through the roof, okay? Number two, about manufacturing. Remember I said just now, Donald Trump wants to bring manufacturing, wants to bring production back into the US, but I think it's not a very correct move. Today we're going to go through this little smile curve over here. It's not a volatility smile. Basically, it's just a manufacturing curve over here. Now, this is a value chain, a simple value chain of a manufacturing process. On the left-hand side, you see R&D, industrial design, you see procurement. Then you see production, distribution, marketing, and services. More or less, it's like that. So if you think about your iPhone, designed in California, on the left-hand side is R&D. And further down, production, assembled in China, and then going forward, sales and services by Singtel, by M1, by StarHub, things like that. Now, a paper in 2011 by one of the American professors, he said that production of a product for a nation, the value added per unit is the lowest. I remember there was a calculation for iPhone that cost, I think, $500 or $600 in US dollars. The value added per unit for China that does the production is only $5 US dollars. Very low. And this is exactly also the same reason why in Singapore, our government, through various budgets across the years, wanted us to get away from production. And there's this new, sexy keyword that came out that's very popular amongst the civil service. It's called the servicization of manufacturing. Basically meaning doing anything on the left or on the right of production, but don't do production unless it is a very high value added item like semiconductors or biomedical pills and things like that. So in this space, I'm seeing in the next 10 to 20 years, some of the ASEAN countries will be very much doing production, and they could be centered around the Mekong Delta region. They could be, and the first one that always is in my mind is Vietnam. In fact, Vietnam today is making lots of things that in Singapore we have been making in the 80s already, right? So production will be fulfilled by some of the developing ASEAN countries, and China is moving up the upstream or downstream of the production of the manufacturing value chain. And traditionally, we are seeing Singapore and some of the more developed countries doing the R&D, doing the sales and services. And where do you think US is on this production value chain? Are they doing production? No, they are not. Because production should only be done by countries with their comparative advantage. And what's that? That's low labor cost, right? In the US today, you think they have low labor cost? No, not at all. So US is already doing up there. They are doing R&D, they are doing sales and services. You see your iPhones designed in California, right? So it's a big contradiction that Donald Trump wants to bring production back to the US because that is not where their comparative advantage is. And remember during Trump's campaign, he kept saying, he pointed fingers at China, right? And he said that, China, you are stealing our jobs, right? He said that, right? And how did Donald Trump arrive at that conclusion? Very simple, he has access to this chart. Now this chart shows the balance of goods. Basically, what does US export to China, or the rest of the world here, and what does China export to the US? And if the US imports a lot more from China than they export to, the US then has a net trade deficit against this particular country. And for China, you can see, China, the US trade deficit with China is negative $366 billion US dollars in 2015. right? And it has grown very significantly since the 2000, just before China entered the WTO. So conveniently, if you're Donald Trump today, you just say, oh, China, minus 366. Okay, that means you're stealing our jobs. We are going to label you as a currency manipulator. We are going to make sure American companies in China is going to shift back to the US. Remember during his campaign, he also said that Singapore, you also are stealing our jobs. Remember that? Right? Now that's weird, because on this chart, if you see, where's Singapore? Okay, that's Vietnam. Singapore is up there. But is it a deficit? No, the US has a net trade surplus with Singapore in goods, okay? When Donald Trump saw the chart, he didn't look at the services side. But when you talk about trade, it's usually goods and services. But the thing is that the data for goods is usually quite easy to come by. Services a bit harder. But if you dig further, you can get the services picture. So in this case, you can see that Hong Kong and Singapore, we have net deficit against US. That means US has a trade surplus with us, and you shouldn't point finger at Singapore for stealing the jobs, right? And in fact, I remembered when he was pointing his fingers onto Singapore, saying that we stole the jobs, his campaign office actually outsourced a presentation, right, to a Singapore girl, right? That's weird, okay? Yeah. Now, the harder to take number is the balance of trade in services. From this chart, you can see it's so different from the previous chart. Previous chart, everything on the left-hand side, that's where the US has a net trade deficit in goods against all these other nations, except for the top two. In this chart is services. The US has a net trade surplus in services against the rest of the world. So in fact, you'll be right to say that the US service industry is stealing the jobs from the rest of us. Really. And in fact, if you look closely, China, the US has a net trade surplus against China. Meaning that in this case, the Chinese has been importing a lot more services from the US than they are exporting to the US. So Donald Trump conveniently didn't see this. Because if you look at this, he don't know how to angle himself to win his votes, basically, right? Okay, and Singapore, we also import a lot more from them. Now, I remember I was in Beijing right after Donald Trump won the campaign, and I knew that definitely Chinese, the Beijing people, my clients will definitely ask me, so what is the impact on China? So I showed them this chart. I said that, wow, the impact on China should usually be from the trade side. Because just now I asked you to remember, China is going to increase 45% import tax, right? So in this case, if US is going to increase import tax by 45%, it will harm the trade sector immediately, and that's the export sector. So in this case today, 5 minutes. Okay, thank you. In this case today, we want to see which country is more reliant on which country. And in this case, if you see, the Chinese imports from the US only grew at 12% per annum, but the Chinese exports to the US grew at 17.5% per annum. In this case, if you look at it, it seems like, wow, China is a lot more reliant on US than the other way around, because a lot more exports is going there. And the bar chart there is a lot larger, right, in terms of billions of dollars. But if that analysis stops there, you're only seeing half of the picture. Because if you go one step inside and you find out, so what on earth are the Chinese importing from the US, and what on earth are the Americans importing from China, you see a very different picture, and that will change the game altogether. So if you go one digit further, right, this shows the different types of goods that the Chinese and the US have a net trade surplus or deficit against. So basically, anything above zero, right, the US has a trade surplus against China. And anything that is, in fact, there's only one thing here. This category is commodities. So in this case, the Chinese imports a lot more commodities from US than the other way around. What is this? It's actually soya beans, Dao Hui, right? And so Dao Hui is healthy. My CEO said be healthy, drink Dao Hui. Okay, so and if you can see over here, the light blue color portion, miscellaneous manufactured products, and these are clothes, simple toys and things like that, right? And before China ascended the WTO in 2001, back in the 90s, they were exporting a lot. So basically, the US were importing a lot of simple, low-value items from China, right? And that was the most during that time. But something changed after 2005. Chinese technology has grown so quickly in that short span of time that they have been exporting, 05 around here, they have been exporting a lot more machinery to the US. Machinery is a capital good. Capital goods are not what you're seeing here. This is not a capital good. This is a consumer good. The mic is a consumer good. The capital good is the machinery that makes this consumer good. So now, second thing. The US says that they're going to bring manufacturing companies back, right? From overseas to the US. But they have been importing so much machinery from China at such low cost. Machineries are important. Robots are important for manufacturers to make the products, consumer products, right? And in this case, if you're going to levy a 45% import tax hike against machinery, that means also for the manufacturers who eventually go into US, they're going to see a 45% increase in their production cost immediately. So that is another big contradiction. Can I go on? How many more minutes? Okay, last slide. Okay, I was also telling the Chinese clients that don't worry too much because there's a big contradiction in what Donald Trump has been talking about during his campaign and promising. And in fact, this time around, it may not really hurt China that much because from the data, we are seeing that the US anyway isn't importing from China and the rest of the world that much. Okay, in the common idea is that the US is a very large consumption society. So every time when wages are rising, unemployment is falling, people are feeling satisfied, workers start to consume because they have certainty of their income for the future, and consumption is 70% of the US economy, right? So basically that will start up this engine of growth for the rest of the world because a lot of us here are exporting engines and we do the exports for the eventual consumption by the US. So that was the thinking behind that, and we saw that during one of the periods of a US recovery, and that was 02 to 08, the yearly imports grew at 9.5% from the US, in the US from the world. And from China, it grew 20%. So consumers were hungry. They have a certainty of income for the future. They start to import a lot more because they basically don't produce the goods in the US, right? And the second period of recovery, 2010 to 2013, the US increased their imports from the world 10%, from China around 10%. But during this period of recovery, which you saw unemployment falling to sub 5%, the US isn't really importing from the rest of the world anymore. And exactly it's during this period of 2014 to 2016, you saw Singapore's exports also almost contracting every month, right? Now, what is the reason behind this? There's a couple of reasons. Number one, the key reason is the US dollar. The US dollar has been appreciating quite consistently since 2012, 2013. Against the Sing dollar, I remember back in 2012, it was 1 US enables you to get 122 Sing dollar. Today, 1 US gets you 142 Sing dollar. What that means is that when your US dollar is appreciating, your real purchasing power is stronger. So imagine back in 2012 when 1 US dollar gets you 122 Sing, this thing here costs you $10, right? But today, because 1 US dollar gets you 142 Sing, maybe it costs less than $10. It costs maybe $9 or $8. So in the total import value, it didn't increase. In fact, it fell. So that's number one. Number two is much related to the labor cost in China. Chinese labor cost has been moving much higher across the years and is narrowing the spread between the labor cost in China and the US. So some of the companies some of the American companies in China has also been shifting back to the US, and that's way before Donald Trump's time. And number three, the key reason why we are not seeing very strong imports from the US is that, remember, energy prices started falling back in 2014. One of the things that caused was that a lot of energy-intensive American companies also started shifting back to the US. So I think because of the time limitation, I do have a lot more slides to share, but because of time limitation, I will stop here. At least you have good takeaways in terms of thinking that what Donald Trump is saying could probably be bugs and not bytes because there's just too much contradiction behind there. I hope to share something about Singapore, but there's no time. So hopefully another time. Thank you, everyone.